Thank you for attending the short selling panel. Appreciate you all being here, so welcome. We wanted Michael Cross to give us the overall welcome, so here's Michael Cross.
Yeah, thank everybody for attending. A couple of things we'd like to do is to introduce our sponsors. We have annual sponsors, of which, because I can't ever remember the title, pay $5,000 to make this possible. And we have the Cosmos CPAs. Is anyone from there in attendance? And we have a new sponsor, the accounting firm KPMG. Would he raise his hand? And we also have $2,500 sponsors, and that's Convergence Prime Services, JP, Michael, anyone else? And then Partnership Financial Consulting, Keith is right there. And I'll go ahead and second call out to Convergence Prime Services because they're also our event sponsor. They're basically paying for the appetizers and the alcohol, etc. And one of the traditions that we have had here is that it really benefits people that have never been before. We like to go around and ask everybody to stand up, introduce themselves, their company, and say a sentence or two about their business. So I just want to take a second and talk about this organization. This coming February will be 6 years old. And we've had some events where we've had a much larger crowd than this. Sometimes we get conflicted with a hockey game or whatever. But the idea that Greg and I came up with was to have an organization for hedge funds and private equity funds and real estate funds to both network and also to learn from a panel or a group of speakers, and also to raise money for charity. So those basically are our three missions: is networking and education and charitable. Thank you.
So let's get into the program. Just to calibrate, while you're giving your introductions, I'd like to just get some feedback from Jason in the back to see that the audio is being captured on the video.
Just talk loud if you can.
Okay, so talk louder than you would comfortably talk. This is the first time we're trying to record it on video. It'd be nice to have it available on the website to refer to. But before I let them introduce themselves, I just wanted to mention that the S&P notched its 33rd record close this year, and we're here to talk about short selling. What is wrong with us? Just wanted to give a quick perspective as an allocator on short selling, and then let the panelists introduce themselves and get into some other topics. As an allocator to long-short equity strategies since the early 1990s, I find short selling to be an extremely scarce skill set, much more scarce than the hedge fund industry would have you believe. It really requires a different risk management regime. You manage your shorts completely different than you do your longs to control the size. And I think that the best practice that I've seen, it's been practiced by some hedge fund reporting here in Nashville, is really to stratify your return attribution and your risk attribution by industry sector. There's very few people that do that, but that's that's to me shows that what they're measuring, they're trying to manage, and it's often difficult to get that kind of risk and return attribution. The guidance that I'm going to give to the panel to introduce themselves is to describe what they do and how they do it quickly, but to end with the answers to two questions. One question is a quick assessment of how they see short selling in 2013. That's the topic of the panel. And number two, to really describe how you see the role of short selling in a portfolio. Short selling is very nuanced, and I'm going to give them four choices. The role that short selling can play is as an absolute return short. This is where you're supposed to make money on that short regardless of the market direction. B is a relative return short, or an alpha short. That's where your short tries to beat something like being relative to the S&P or an industry peer. C is a beta short, where you're using an ETF or index funds just to lower beta in the fund. And D is any of the above and all of the above, or a combination of the above. So with that, I'll put Tom Landstreet on the hot seat. Could you describe, quick 2-minute drill on who you are and answer those 2 questions?
I am the founder of Telltale Capital. It's an emerging 2-year-old equity investment manager. We have 3 strategies. One's a hedge fund strategy, it's just our own money. We have 2 strategies that we have client money in. One's growth, one's value, and we do beta shorting in both of those. The client money, that is reducing beta or hedging slightly, trying to reduce volatility. As far as using, and also I produce research for other hedge fund managers, because that's my background really. And so I have about 12 hedge fund and mutual fund clients that pay me for thematic ideas, long, short, and thematic. And so I used to work for a guy named Mark Laffer, and so I've married macroeconomic policy research with stock picking. And as far as shorts in 2013, obviously with the Fed's activities, it's been very, very difficult. But quite possible and much more valuable. Finding a good short idea in 2013 has been extraordinarily valuable, not only to portfolio managers, but to performance. And there are shorts out there, usually groups of stocks. It's hard to find an individual stock that's suffering in this environment. The economy and stocks separated early this year. The economy is doing very poorly. Stocks are doing very, very well. And that's because of the Fed. So if I were to just kind of give it a sentence about shorts in 2013, extraordinarily valuable to find a good one. Very difficult, but much more, I think, much more important.
One quick addendum on Tom's record. Last year he spoke on the long short equity panel and was vociferously defending his short of Apple, and it turned out to be good. Later we'll get an update on Apple and some other ideas he's got for the next 12 months. Brad, why don't you continue?
Brad Weeks, and I started at KPMG Audit years ago for a few years, and then went into the long short business with a firm called Water Street Capital out of Jacksonville, Florida. Water Street was had 2 funds, a short bias fund and a long short fund. The DNA of the place was heavily short biased, I would say. Always after absolute returns and every idea, long and short there. So I've been doing this for 13 years, left Water Street, co-founded a fund in 2005. I even peaked at about $500 million in long short. I was the number 2 guy there, and then the founder decided to wind down in 2009. Launched Courage Capital long short fund in January of 2011. Currently managing that. Jeremy Tate and Dave Bradley working there. We're long short equity. We've got about 40, 45 investments. We concentrate, I would say, half of our exposure on the long side in our top 5 or 6 names. On the short side, we're actively managing what we think is a stable of horrible companies that we've done a lot of work on, both from an accounting standpoint, a research standpoint, and a due diligence standpoint. Short selling in 2013, everything I just said doesn't matter because everything is inflated by the aforementioned financial situation. There are still phenomenal shorts out there. Quite frankly, there are probably more than there were. The ability to get paid on them in a reasonable manner without getting your head taken off has shrunk drastically. And a lot of short selling is always about the art. You have asymmetric risk, and so you have to have, I say you have to have died a few and won a few, and then the difference is it feels like you really can teach it. So I would say 2013 has been full of landmines. There are still opportunities. And more than ever, I think a really solid, fundamentally researched short idea can pay you extraordinarily well. But the key is you have to live through it, and you have to either have the stomach or the need to have the exposure. As you can tell, we're absolute return on every short idea. I would say today we've got 20 shorts. The average size of our top 5 is about 2.9 to 3%. So for a short, we get pretty concentrated, and I'd say average market cap of the things we're short right now is probably 4 to 5 billion.
Right, I'm Michael DiGiornetto with Convergex Prime Services. I'm the president there, and I am one of the founders. We started in 2006, and the reason I'm on the panel is I was told I was going to be on the panel because we were a sponsor. But other than that, I don't get to feel the same pain these guys feel trying to find enough market on the short side. But I do get to see hedge fund managers from a different angle than most people do, and see the battles that they fight. And I'm here because when someone chooses to short equity securities, and when they're doing their research, and maybe if it's a quant strategy they're back testing, or whether they're looking to see the past performance of shorts that they would have executed, would have had in their portfolio, it's even more important on the short side to know what the regulations are and what really would have happened in your account than it is on the long side. Because on the long side, you don't have to worry about things like Reg SHO. You don't have to worry about only being able to transact on an uptick. You don't have to worry about being bought in. You don't have to worry about, if you're long, you don't have to worry about somebody just coming one morning and taking your best position away from you. Which if you're a short seller, you have, that's a potential problem every day of your life. And a lot of times it seems to happen at the exact wrong time, right before a catalyst or right before an event, right when short interest is at its highest. And also you have to worry about what you're charged every day in order to be in this position. You can be charged anywhere from nothing to 100% annually to be short a security. And that's the kind of thing that a lot of people don't think about when they decide they're going to delve into the short selling part of the market. They don't realize that it's not like just buying 30 stocks and holding them. There are a lot of things that go on that a lot of people don't know. You may have the best idea in the world, but you might not be able to borrow it. And then you've done days, hours, weeks of work for something that now is not a trade that you can even put on. So I'm here just to explain some of the pitfalls there, and hopefully help fill in where these guys need filler.
But you've seen dead bodies all over the street this year.
I definitely have, but luckily I wouldn't say I've seen many dead bodies. I've seen mostly people that are fighting the good fight.
Which was
Yeah, exactly.
I'm Mike Long. After hearing these guys, I guess I'm glad that I'm retired from the short selling business. I got involved in it in kind of an odd way. In 1973, I went up to New York and got involved in futures trading, where there really wasn't a difference between longs and shorts, and I had no idea that people had biases. And most of the involvement was in the quantitative trend following business. I went to work for one of the largest commodity trading advisors in the world, a firm called Milner & Partners, in 1980. And after 4 or 5 years there, I started getting a little bit bored. I had access to being able to invest with some of the money managers that came through the door. One came through that, and I had gotten very bearish on the stock market in 1985. I had decided, I knew that the price-earnings ratio went, I knew nothing about stocks, but I knew that the price-earnings ratio went to 5 or 6 every decade going back to 1900. And it was currently 15, 16, 18, something like that. And I just assumed it was going to, get back to those single digits again. So this guy trots in and he said, well, all I do is short stocks. Explain that to me. Well, you bet on companies that are going to go down, bad companies. And I said, well, gee, that's perfect. So I invested with him, and of course the stock market didn't go down. It went up every month, every quarter, yet this guy was making money. And I was just astounded that you could be so wrong and make money. So I'd never run into an experience like this. So I was just hooked. And it didn't take long for me to change careers. I found another one of these oddballs that only went short and invested with him. Had similar experience, decided to leverage it further, borrowed money from U.S. Trust, started a short-only fund of funds with the most aggressive, youngest, and hungriest money managers. Everything went great, and until the date's pretty hard to forget, January of 1991. And the stock market was really concerned about the land invasion going into Kuwait. And everyone was underinvested because they were afraid there was going to be this protracted war. And lo and behold, it was a slam dunk. It was obvious within minutes that there was going to be no resistance. And so people came in and started buying stocks like there was no tomorrow. The Feshbach brothers were the big force at the time. They had over $1 billion. They were very loud. They were pretty obnoxious. They're friends of mine, but they were just really in your face. The street didn't like them at all. Their positions were photostated and passed around the floor of the New York Stock Exchange, and they were bankrupted within essentially a couple of months. But they took a monstrous hit, and they were over 100% short at the time, probably significantly more than that. Didn't do me a lot of good either. It caused me to do some thinking about what I was going to do next. In explaining the situation to my clients, all the rage at the moment was this guy Ray Dirks, who was talking about how the greatest thing in the world to do is to buy heavily short stocks, which wasn't in my interest. I wrote a letter to my clients. I decided to pass it along to Barron's. I'd never been published anywhere, but I just sent it to Al Abelson. He liked it, published it, convinced me to make an index of these guys. So, I became the expert handicapper of the short industry. My thesis was that it was an absolutely crazy idea to heavily short stocks. And it was just a guess, and it was just logical. But the next day I got a phone call from Paul Asquith at MIT, and he said, we've been working on this for 2 years. He was the head of Sloan School, and he said, we've been working on this for 2 years. I got a bunch of guys, and you're absolutely right. These stocks, provide alpha. They underperform the stock market in general, and I think at the time it was 4 or 5%. So I got much more interested in getting this data, and the data wasn't available in those days. So I created a company to provide the data and sold it to short sellers and hedge funds for $500 a month. They pushed us farther to learn how to do a little bit more than give them screens, which they were going to be able to do pretty quickly on their own anyway. And I started doing fundamental research on companies. In 1996, the company was Short Alert. We had a tremendous start. In the beginning, we looked for nothing but terminal shorts. As things got, and this was
But not shorts. Terminal shorts, but not necessarily
companies that were going to go
shorts.
to zero. They were going to go out of business. And at the time, that was sort of in vogue. A lot of people were doing that. It was really easy then. And the alpha was, it was easy to find them. They actually did what they were supposed to do. Moving the story forward, it got progressively harder and harder and harder. Barron's picked up our story a little late, and it had already peaked by a significant amount, and they picked up our story and put us on the cover of Barron's as small North Carolina research firm earns 20% on short side over each year over the past decade, and that really was the Sports Illustrated jinx of all time. We went completely to hell after that, and but we had seen the writing on the wall, and we had really found it to be much tougher. It was tougher for the previous 3 or 4 years, and we had periods where we knocked it out of the park, but then we got periods where the stocks were on us, and we just couldn't find the quality of names that we found, when we started. So we shuttered it 2 years ago, And as an anecdote about how tough the climate is, I talked to a friend in New York who's been in the hedge fund business for 50 years, long short, and he told me that this year he had gotten numerous requests to provide a long-only fund. He said he'd never gotten clients to ask him for that. And he's going short selling. So short sellers are really unloved right now. Probably a great contrarian play. I don't think there's much that's going to change in the short world. I think people are too glued to their strategies. I don't think there's going to be any big shift. I just think people will probably need to do it differently, and we'll probably need to do it in a more conventional sort of stock picking way rather than more traditional, the way I was used to, the way I was brought up.
Mal?
I was wondering if one of the panelists could give us a short selling idea, either a stock or a theme, or what do you like now?
We're going to finish with that, but what I wanted to do first was
Sorry.
go through the process competitively and then hit the headlines. But if we hit the headlines, I'm afraid we'll never get back to process. But I wanted to start with Mike. And he called it short alerts because he wasn't making recommendations. He was alerting short sellers to something that was fertile for more research. And what I'd like to do is talk a little bit about what Mike thought he needed to do, what his clients paid him for, and then dig deeper into the hedge funds and see how much deeper is the short selling process inside the hedge fund.
Well, our process was, I hinted at it earlier, we tracked what other people were shorting by looking at short interest. And initially the idea was, when asked with that the heavily shorted stocks underperformed, a much more dynamic way to look at it was to just see what they were shorting the previous 2 weeks or month, depending upon the reporting period. So we were tracking new shorting as a percentage of market cap and coming up with a list of about 100 names to look at. You know, that were within a certain market cap range that we felt was the sweet spot for our clients. And then we started eliminating them, trying to figure out why in the world people were shorting these companies. And we would get the list down to 5 or 6 names where we thought we could come up with something that might be why people would be interested in shorting them. And then we dig in. And we wrote 8 to 10 page papers, which was pretty much what the street requires. I think we could have, in some cases, really done people a favor and written a paragraph. But they required the 8 to 10 pages, and what we did was listed an awful lot of pretty traditional stuff. The monkey business, the business model, the accounting issues, the problems that were pointed out in the proxies.
But no financial model.
Pardon me?
When you're sourcing this, you don't have enough time to get
We
earnings per share.
we did not produce earnings estimates. We didn't have a model. We got fired by a lot of people that would call up the day after the report and say, "Can you send us your model?" And we said, "We don't even make models." They would say, "Well, what good can you do?" But we didn't see. We knew that the hedge funds didn't care that if we told them to buy or sell something. I mean, I'd been around enough to know that. So what we did was we tried to make a case to get them interested in this idea, to make a strong enough argument for why they should do more research. And we pretty much left it in their hands. We didn't come back with much follow-up. We did a little bit of follow-up because we had to. We tracked the companies to make sure we hadn't missed something, or that we hadn't they had changed something that we were having a problem with. But we didn't do real serious follow-up research. We moved on to look for new original ideas, and that was our gig.
So Brad and Tom, what does it take to go from sourcing an idea, and I'm sure you have other sources as well, but what does it take to make that final investment decision? In terms of, do you build your own models? Do you borrow from the street?
You never, shorts are they're a little different than longs. You never know. I mean, you really don't. You can do all the work in the world, and you can think this thing's going to zero, and it just doesn't, or something. So we really look for thematic moves that are bigger than the companies themselves. We've been shorting Oracle and IBM for the whole year around their earnings release, and I'll go through that because that's my short idea today. There's something much bigger than even a $160 billion company at work, creative destruction-wise. And you find those frequently, and you find it in bull markets. You just gotta have, it doesn't, you can short a company. It's in a sea full of other companies. Or you can find a theme that's affecting a whole group of stocks. We prefer that. We can sleep better at night with those themes when we're really convinced of them. And then you find, really what's wrong with the company itself. You pick your companies within the theme that you think are gonna be most affected by the theme. That's how we've done it, and I've done it historically since '99, when I first started getting really interested in short my career. Great timing, because the market fell apart 3 months later. And that was, you gotta find valuations out of control, expectations way too high, and something's changed, which is a theme. Or you've got to find a creative destruction, something, or a government policy where they've, had a temporary tax credit. It's benefited buyers of blue blazers for a year, and it ends on a day. And you can guarantee with perfect certainty that anybody that wanted a blue blazer, who knew about that temporary tax credit, bought an extra blue blazer and would not buy a new one for another year. So we look for government policies and how they rearrange the economy in thousands of ways. We find lots of thematic shorts that way, and then we find our favorite within that theme.
Yeah, I mean, we build models on everything that we touch, so I would say that we're looking for situations where there's a disconnect in what's really happening and what the perception is. Valuation is a part of that, but it's only a part of that as it relates to the story. So we're not going to look at a stock that's at 40 times earnings and say, wow, that's probably a good short. It may not be nearly as good a short as a stock at 8 times earnings who's just lost 2 of their top 3 clients and has decremental operating margins of 80%. So, I would say what we've developed a knack for over what I have over 12, 13 years is getting to know businesses. I mean, the analogy I use is a business is a very simple mechanism. You put capital in, you get capital out. So it's tantamount to a physician seeing patients. A good physician can tell you if you're healthy, but he better be able to tell you if you're not. And it's the same skill set that allows both. So we're, whether you want to call it forensic in our analysis of balance sheets, there's some of that. It depends on the story. If it's a one-product pony, $1.5 billion cap, and we know that people are using it because there's a temporary supply disconnect and Wall Street thinks it's going to grow 40% a year for 3 years, we know it's not. We believe it's not, we perceive it's not, and that really comes from a library of having done this 1,000 times. What we do is we lay out the pieces. What's the opportunity? Why do we think it exists? How are we going to get a real advantage? Not this is better than we were, but how are we going to get an advantage and understand what's actually happening here? And then when is everyone else going to have to admit it? Now the when, if you said which one of those 4 is most difficult now, it's the 4th one, no question. A good long idea that you think you're going to make 80% on this year, that you make 20%, 25% a year for 3 years, that's still a pretty good investment. A short that you've lived with for 3 years is terrible. I don't care, unless it goes to 0, which is very, very rare. Your level of risk you carry for the period of time it takes to execute that, time works against you because every day that a business produces any kind of returns, they can do something with them. So. It's very difficult to articulate what specifically makes a great short, except for there's an information arbitrage. You're able to prove the gaps. You understand where you are and where they are, and then you're able to prove that out. And I would say that typically that's in the $2 to $5 billion cap range. We've had instances this year where $20 billion market caps that basically live off of 1 or 2 products. What we found is people get really excited about things and stop asking why. So if there's one characteristic I would say of a great short seller, it's someone who continues to ask why. They never stop. It's, well, this is a great business, it's got 30% EBITDA margins, why? Most people can't get to that second question at all. If they can, then you go to the 3rd question, the 4th question, until you land on something that's fundamentally structurally real. And quite frankly, we look at our longs that way as well. So we're I would say the short, by definition, shorts take probably 2 times as much energy as longs. To your point, it's a very beleaguered craft, especially now. A real short seller gets excited when nobody else is shorting. Not to say he's gonna survive any longer, but that's typically, when everyone's on one side of the boat, typically there's a reason. But you know, it's no different than it was. I mean, I came to the business in 2000, and you know, we were still ordering packets from companies and waiting a week to work on things. And so, you know, that wasn't that long ago. So back, you know, what you had to do then was stage your work so you didn't wind up without packets. It was ridiculous, right? I mean, you remember. But then you would go do the due diligence, and there was nobody around. I mean, there was just money laying on the ground, and you would go find it. And it was easy. The craft wasn't easy, but there was nobody else in the room. The problem now is there are a lot of people in the room, but they're not really there for the same reason that you are. So it's not very uncommon at all for us to be short a company that's a 7% short interest. And by the time, you know, it plays out, it's 25. And that's frustrating because people are coming in and out, and you're trying to be still. You know? So it's a very different environment. There's no difference in what makes a good business today and what made a good business 40 years ago. And I think that's the deception that befalls investors, but to a positive and to a negative. It's not a negatively biased statement. But if you don't know why you're making money, you're already in trouble. And so, you know, a lot of people are making money currently because of the Fed DAX stop, and it's working. It's actual money. You're actually making money. The question of how long will that continue and so on, I have an opinion like everybody else does, but that's not going to influence whether intuitive surgery is going to make their sales numbers this week. Now, what I do have to dance with is the fact that they may miss their numbers by 8%, 9%, and nobody cares. And that's the survival mentality that you only really learn over time. You can't teach that in school. You know, so over time you learn this is just like X. I remember in 2004 there was a company like this. You know, how is this different? How is this the same? And I think that library of experience is really part of the ability to truly create alpha with shorts. But ultimately, the best way to make money is to be right.